Hey, what's up, everyone? Welcome back. Bitcoin is at $69,293 right now, and I want to explain exactly why that number is significant because it's not just a random price level. We've had 5 consecutive red monthly candles. A death cross just appeared on the 3-day chart for the first time since June 2022. Ray Dalio went on a podcast this week and said Bitcoin isn't a safe haven, and yet Michael Saylor just made his 101st Bitcoin purchase, buying another 204 million worth below his own cost basis. And ETFs pulled in 458 million in a single day on Monday alone. Two very different narratives, both backed by real data, and Bitcoin is sitting right in the middle of all of it at $69,293, inside a triple resistance cluster that's going to tell us a lot about which narrative wins. So let's start with the chart because the setup here is genuinely one of the more important technical moments we've had in this entire cycle. Bitcoin is sitting inside a resistance zone with the three separate components stacked within about 2.5% of each other. The 200-week EMA at $68,330, the 2021 all-time high at $69,000, and the $70,000 psychological level right above. All three right here, right now. A weekly close above 70k would clear all of them simultaneously. Without that, this whole zone could act as a ceiling and send price back towards $62,000 to $65,000 range. Now, let's talk about the dead cross because it's all over crypto Twitter right now, and I want to give you the full picture rather than just the headline. A dead cross on the 3-day chart just formed, the 50 period MA crossing below 200 period MA. First time this has happened since June 2022. Historically, when this pattern has happened, Bitcoin has averaged a 35% decline over the following month. In 2022, after the same signal, Bitcoin dropped around 50% before bottoming near $15,000. So yeah, that's a real bearish signal. I'm not going to dismiss it. But here's the other side of the data. Over the following 12 months after a death cross, Bitcoin has averaged a 30% gain, and critically, Bitcoin has already dropped roughly 50% its October peak before this death cross even formed. In prior cycles, the death cross often appeared mid-correction, not at the start of one. The question is whether we're late in the correction or just beginning a new leg lower. That's honestly the crux of the whole setup right now. If you're actively trading around this 69,000 level to 70k level resistance zone or watching the death cross setup, I personally use Bitunix to manage my position. It handles these kinds of high stakes technical setups cleanly. Link is in the description, by the way. Now, the sentiment is still sitting at 10, deep in extreme fear, and this week we've got another headline that added to that narrative. Ray Dalio went on the All In podcast and said, and I'm paraphrasing here, the Bitcoin isn't a real safe haven, and that when it comes to stores of value, there's only one gold. Now, Dalio is someone worth paying attention to. He's not a Bitcoin hater. He's actually recommended a 15% portfolio allocation to Bitcoin or gold back in July. But his argument this week was essentially that gold has central bank support, Bitcoin doesn't, and in times of genuine crisis, that distinction actually matters. And look, the data since October does support his point to some extent. Bitcoin is down about 45% from its all-time high. Gold over that same period is up roughly 30%. Now, sitting around $5,120. That's a significant divergence in a relatively short time frame, but here's where I'd push back on the framing. Bitcoin and gold are serving different functions in a portfolio. Dalio is comparing them as if they are competing for the same role. Gold is a central bank reserve asset with centuries of institutional trust. Bitcoin is still in an adoption curve. ETFs only launched a couple of years ago. The relevant comparison isn't Bitcoin versus gold today. It's Bitcoin in 2026 versus the Bitcoin in 2030 as institutional infrastructure continues to build. The fact that sentiment is this negative, Dalio cautioning that cross forming 5 red months and price is still sitting at $69,000 inside a major resistance zone rather than having collapsed further actually tells you something about where underlying demand actually is. Now, let me give you the institutional picture because it's the sharpest contrast to the bearish headlines right now. ETFs pulled in 458 million in net inflows on Monday alone. That's a single day number, and it came on a day when the Middle East situation was still front and center. The death cross was being discussed everywhere, and sentiment was firmly in fear territory. Institutions didn't wait for clarity, they bought. And then their Sailor strategy just completed its 101st Bitcoin purchase, 3015 Bitcoin for 204 million at an average price of $67,000. Their total holdings are right now 720.737 Bitcoin acquired for about 54.8 billion in total. Their average cost basis is $75,000 per Bitcoin. Here's the part that I think is really worth sitting with. They bought at $67,000, their cost basis is 75k. That means they're buying below their own average, which is something only small number of their purchases have ever done. The last time they were consistently buying below cost basis was 2022 and 2023, when price was around 30k. We know what happened after that. On-chain MVRV is still on fair value territory. OneFlow model currently prices Bitcoin's fair value at around 95k based on the current ETF inflow trajectory, meaning at 69,000 we're trading at roughly 41% discount to that estimate. Models aren't guarantees, but the directional signal is clear. Here's something interesting that Arthur Hayes raised this week, and it adds a different macro dimension to the Iran situation. Hayes argued that the longer the US stays involved in costly Iran conflict, the higher the probability that the Fed is eventually pushed toward easier monetary policy, more money, lower rates to finance it. If that plays out, it's historically one of the most constructive macro environments possible for Bitcoin. It's not the base case today, but it's a scenario worth keeping in the back of your mind. Now, for everyone positioning around these ETF inflow signals and the Sailor accumulation level, Bitunix is what I use for executing trade. Link is in the description below. Now, let's zoom out to the macro. ISM manufacturing PMI just came in at 52.4%, the second consecutive month of expansion. That matters because it tells you the underlying economy isn't rolling over. A soft landing that stays intact is broadly constructive for risk assets. It removed the urgency for emergency Fed action while keeping liquidity conditions relatively stable. The Fed meets on March 18th, cut probably is near zero, 4.4%, but what I'm watching isn't the March decision, it's the language, and any dovish shift in how they discuss inflation or the Iran risk could reprise June expectations and move markets well before an actual cut happens. The gold comparison Dalio raised is actually worth using as a macro signal here. Gold at $5,120, up 30% since October, is pricing in something. It's pricing in currently debasement risk, geopolitical instability, and dollar weakness all at once. Bitcoin, by contrast, has sold off 45% over the same period. Historically, when that kind of divergence between gold and Bitcoin has closed, it's Bitcoin that catches up, not gold that pulls back. Global central banks outside the US are still easing. The structural liquidity trend is still toward expansion. The dollar is structurally softer. None of that has changed. Iran is a near-term variable. The macro foundation under Bitcoin is still intact. And by the way, Bitunix is my go-to platform for managing my positions through setups like this one. Link is in the description and it supports the channel directly, which I appreciate, by the way. Here's where I stand. We've been adding through the 62,000 to 67,000 range over the past few weeks. I'm not adding more up here at resistance. What I'm watching for is a clean weekly close above 70k. If that happens, I would look to add on any retest of that level as support. If we get rejected and pull back towards 65k, that's still within a normal consolidation range, and I'd be comfortable adding there too. The death cross is real and worth respecting as a risk. The daily argument about gold versus Bitcoin has merit in the short term. The divergence is real, but Sailor buying 204 million below his own cost basis, ETFs pulling 458 million in a single day, and Bitcoin holding 60k level through a military conflict and a bearish technical signal all in the same week. That's not a behavior of an asset in terminal decline. Base case is Bitcoin clears this resistance zone over the coming weeks, The 5-month losing streak ends in March, and ETF inflows continue to build as institutional conviction holds. Risk case in Iran escalates, oil spikes, inflation surprises higher, the Fed turns more hawkish, and the debt cross plays out toward the 45k to 50k zone. Both scenarios are real. I hold the base case at higher probability based on everything I've talked through today. What I'm watching is weekly close above or below 70k this week, Friday's 10.5 billion options expiry, whether ETF inflows sustain, and Fed language shift on March 18th. Drop what you're watching in the comments. I read all of them, and if this breakdown is useful, subscribing helps me making it. Alright, take care, and I will see you guys in the next one.